So in this video, I'm going to show you some examples of credit spreads on the SPY. I wanted to make this video because I really want to show what is my thought process when trading credit spreads, and I want to take the SPY as an example because this is the S&P 500 ETF, so it's kind of considered as the benchmark. And credit spreads, I think, in my opinion, it's an amazing strategy, and I really want to be transparent in this video and show you why I take the decisions that I take, how I choose my strikes, what are the things that I'm looking at, what are the things that you need to pay attention to, otherwise you have some very big risk. And all of this I'm going to present in this video, so hopefully it's useful for you if you want to do the same in your own trading. But before diving into this video, if you find it interesting and you like to see more videos like this one where I share my thought process on some strategies, like for example credit spreads, don't stay to subscribe to my channel and liking this video. That's really the best way you can let me know that you appreciate this type of video and that you like to see more videos like this one. So before going into really the credit spreads directly, let's look at the SPY first of all. So as you can see, the SPY is now very high. I mean, compared to where it was last year, now it's at 417, when last year around the same time it was at 286. Remember that we just got out of a COVID crash, and during the COVID crash the SPY went from 336, it fell I think to 220, something around this, and now we are at 417, almost double what we were at the low bottom at the end of the COVID crash. So that's really impressive to see that the SPY came back from 220 to now be at 417. So now it raises the question, if you wanted to trade the SPY, what would you do? Well, as the subject of this video is credit spreads, I'm going to stick to credit spreads. For example, I want to show you what I would do personally if I was willing to trade credit spreads on the SPY. So I'm going to present both cases. I'm going to show you if you are bullish, if you are bearish, and then I'll give you my opinion on what I think the SPY is going to do and how I would trade the SPY based on my personal opinion. So first of all, let's imagine that you are bullish on the SPY. In that case, you need to sell a put credit spread. When you sell a put credit spreads, you have a bullish assumption. If the stock goes up, then you'll make money. If the stock goes down, then you lose money. So if I was willing, for example, to trade the SPY and sell a put credit spread, meaning that I'm bullish on the SPY, here's how I would personally do it. So first of all, if we go into the option chain for the SPY and you see that we have all of the different expirations, the first question that we need to ask ourselves is, which expiration should we choose? Personally, I like to stick to monthly expiration when I just trade on a portfolio basis, meaning that I'm going to have trades that are going to last several weeks. For this type of trade, I like to stick to monthly expirations. As you can see, the closest monthly expiration that we have is the May 21 expiration. So as you can see, it's expiring in 20 days. And usually when I see that the next monthly expiration is, let's say, less than 25 days or around this, it's like 25 days to expiration or less, I'm usually going to go on to the next one, which is going to allow me to have a longer time between the moment I'm selling my credit spread and the expiration. So in that case, the next expiration is the June 18 expiration, and it's expiring in 48 days. And as you can see, it's 28 days more compared to the May 21, 2021 expiration, where there is only 20 days to expiration. And there are different reasons why I like to do this that way. The first reason why I like to do this is that it gives me more time to be right. And it's very simple. If you have 20 days to expiration, then you have literally 20 days to be right in your trade, or you're going to be wrong. And in a trade where you go for a longer dated expiration, for example, like the June 18th expiration, I'm just taking more time to be right. And personally, I really like to let my trade go, breathe a bit, and try to see where it goes. I don't like to be in a rush necessarily. So this is about the first reason. However, there is a second reason, and this is probably maybe the biggest reason why I do this that way, is because of the gamma risk. So the gamma risk is something that I've been talking about in my previous videos. To make it very simple, the closer you are to expiration, the more your P&L for that trade will depend on the stock's movement. And the further away you are from expiration, the less your P&L is going to depend on the stock's movement. In other words, if you're close to expiration and the stock, let's say, moves by $10, then you're going to feel it a lot more in terms of your P&L volatility compared to if you were, for example, selling a credit spread on an expiration that is expiring in 50 days. That's the concept of gamma. And if you want to have more explanations, because I'm not going to go into too much detail in that video, I will put into the description of this video the link to a previous video that I've made that explains more the gamma risk in more details, and I show examples, so hopefully it'll be useful for you. So as I said, I would go for the June 18th expiration, for example. So in that case, I would go into the June 18th expiration, and as I said, here we're going to be bullish. I'm going to show you an example of a put credit spread as if we were bullish on the SPY. So when you want to sell a credit spread and you are bullish on the stock, then you're going to have to sell a put credit spread. In that case, you're going to go into the put section. You see that there is a put over there. That's the put section. And in that case, I'm going to sell an out the money option, and I'm going to buy a further out the money option at a smaller price. And no worries if you don't understand exactly, I'm going to go step by step so it's completely clear. So usually when I sell credit spreads, the short option that I'm going to sell, the short out the money option that I'm going to sell, I like to stick to the 30 delta strike. And for those who don't really know what is delta, delta is the Greek letter. I'm sure that you've heard about those Greek letters in options, and delta refers to the rate of change for every dollar move in the stock. And delta has a particularity, meaning that we tend to associate the delta to the probability of being in the money. Meaning that if you, for example, go for the 30 delta and you sell, for example, an option that is at the 30 delta, in that case, we said that the option has roughly 30% probability of expiring in the money. And because it has 30% probability of expiring in the money, then it has 70% probability of expiring out the money. And when you sell options, you want your option ideally to expire at the money. That's how you're going to make a profit. So when you sell an option that has a delta of 30, in that case, you're going to sell an option that roughly has 70% probability of profit. And that's something that I use a lot, meaning that if you've been watching my videos on my channel, you know that I talk a lot in terms of delta. That's a very quick way of knowing where are you in terms of out the money, how far are you going to sell, for example, your options, and that's a very quick way of knowing this. So if you're not used to talk in terms of delta and where you're going to place your strikes, honestly use that because that's very useful. So as I said, I would sell my option at the 30 delta strike. So in our case, as you can see, I have this column where there's all the deltas, and if we look for the 30 delta, you see that it's around there. And if we go for the corresponding strike, you see that it's the 403 strike. So in our case, I'm going to sell that option that is located at the 30 delta strike. In our case, I would collect a credit of $5.69, making a potential max profit of $569. But as I said, we're not going to just sell that option. We're going to buy another option at a lower price so as to protect our downside, meaning that if there is a crash, let's say, we're not going to be in too much of a loss because we will have a protection. And to make you really understand the concept of credit spreads, then it's just not a strategy like, you know, any other strategy, why it's actually useful of using credit spreads compared to only using naked options. Imagine the following. Here you see that I sell that 30 delta option, and if we go into the P&L graph, so the P&L graph basically shows you a snapshot of where you would be at expiration and if the stock was, for example, moving. So you see that, for example, the stock is where there is the green flag. So here, if the stock stays there at expiration, I will make my max profit of $569. But you see that if the stock goes below my strike, below my 403 strike, then I'm going to be at a loss at expiration. And you can see that the loss really goes far. For example, if the SPY was falling, let's say, to 300, you see that I would be in a loss of $10,000. And that's something that is so important to understand about naked options. You can really be in big drawdowns. And personally, I use naked options. I use them quite often, actually. However, this is a risk that you really need to be aware of. And if you're not fine with that risk, then you should absolutely not sell naked options. And the purpose, and the whole purpose of using credit spreads is to protect yourself and not be in a big drawdown. A drawdown would be a big running loss, for example, $10,000. The purpose of using credit spreads is to avoid being in this type of big running loss and have that long option that you bought in a way as an insurance. And let me show you directly. Usually when I tend to sell credit spreads, so I sell the short option around the 30 delta strike, and I'm going to buy the long leg around the 5 delta strike. So if we go, for example, into the option chain that I was before, if I go further out the money, you see that now in terms of delta, you can see that there are several 5 deltas. So I'm going to go, let's say, for example, for the 349 strike, and I'm going to buy that option for $1. So what does it do? Well, if we go back into the P&L graph, for example, now you can see that my loss is not going further than the 349 strike. You see that it's being capped. Even if the stock continues to go down, I'm going to still be at the same max loss than if I was, for example, if the stock was at the 349 strike. In our case, I would be in a max loss of $5,000 maximum. So of course, it's still $5,000 and it's still a consequent loss. And I'm not saying that it's small. However, it's nowhere near what we were before. If, for example, the stock was falling to 300, and who knows if there is a crash, how far it could actually go down. And that's really the purpose of buying that long leg. When you buy the long leg in the credit spread, that long leg, that long option that you're buying is an insurance. You're paying an insurance where if, for example, in our case of the SPY, if the SPY crashes, then you're not going to be in a too big of a loss. And that's so important to understand. This is nothing more than just an insurance that you're buying. For example, if you're buying an insurance for your car in case of a crash and you have a crash, then you're being protected. If you hadn't bought an insurance for your car and then you have a crash, then you're going to have to pay from your own pocket. Well, that's exactly the same concept when you, for example, use credit spreads. If you hadn't bought that long leg, then you're going to be in a big running loss if the SPY crashes. However, if you buy that long leg, then it's going to protect you against a potential market crash, and you'll still be in a loss, but in a way smaller loss than if you had just sold a naked option. But obviously, when you see that I went that far out the money, you see that I've bought that long option at the 5 delta, meaning that the 5 delta option that I just bought has roughly a probability of expiring in the money of 5% because it's the 5 delta, so 5% probability of expiring in the money. And so a probability of expiring out the money of 95%. But why did I do this? Why do I go that far at the money? Well, the reason why I go that far at the money and I don't necessarily like, for example, to buy the next option just after, for example, my short option around the 25 delta strike, I prefer to go way further at the money so as to pay really a small price. Because if we look at the price, for example, that I just paid, I paid $1.01 for that long option. And when I sold the other option, my short put, you see that I received $5.69. And for me, it's still important to preserve my potential max profit because my max profit is only in my short option. That's the short option that is going to determine how much money you're going to make. So I don't want to hurt too much my potential max profit by buying another option that is going to eat all of that profit. I want to go further out the money because I really want to only consider that long option that I'm buying as an insurance in case of a crash. And the other benefit of buying a further out the money option, like way further out, for example, the 5 delta option that I'm just buying it, for example, for the SPY right now, well, in case the SPY goes down, for example, let's say that it goes around the 370 strike, so it would be right in the middle between my long leg and my short leg. The benefit of having bought, for example, a 5 delta option is that I paid so little money for that compared to my short option. Well, I'm going to be able to defend my trade. What do I mean by that? Well, I'm going to be able to roll out my trade, and that's something that you must have heard about. That's a technique that we use when we sell options so as to basically give ourselves more time to be right. And in other words, it just means that instead of just taking a loss and moving on, you just take your loss actually, and then you resettle another trade that has potential to recoup all of that previous loss. That's what rolling is. And when you sell very wide credit spreads, you're able to roll your trade to a later expiration much more easily compared to when you are selling very tight credit spreads. And let me show you directly. For example, instead of, selling the 5 delta strike, if I bring my long leg a lot closer to my 403 puts, yes, I'm going to have a way smaller max loss. So you see that now I have a potential max loss of $325, which is a lot less compared to before where my potential max loss was of $5,000. However, if my trade goes wrong, there is very little I'll be able to do so as to correct my trade, so as to defend my trade. Because the whole concept of rolling is to roll what we say for credit, meaning that when you roll for credit, it means that you're going to close your current position. and sell another credit spread into a later expiration, all of that transaction will be for credit, and that will have for effect to increase your max profit and reduce your max loss. And if you don't roll for a credit, then you're going to directly lock in losses, and that really goes against the purpose of trying to recoup those losses, because if you pay a debit when you roll, then you're literally locking in losses. So that's not what you want to do. You always want to roll for credit. And when you have very tight credit spreads, it's very hard to roll for credit. Hence why I really like to go for very wide credit spreads. Instead of, for example, being very close to my short option, I like to go for wider credit spreads, and I have a double benefit. As I said, on the first hand, I conserve most of my credit that I had sold on my short option, and so I have the potential of making much more if I only sell wide credit spreads, because my profit on my short option is almost untouched, because my long option that I'm buying represents so little relative to my short option. And if the trade goes wrong, because I only have paid my long option $1.01 in that example, I'll be able to roll my trade to a later expiration much more easily compared to if it was a very tight credit spread. And on top of that, I'm protected against a potential crash. If there was a crash, I wouldn't be in too bad of a loss. Yes, of course, that would be $5,000. That would still suck. However, that wouldn't be necessarily $10,000 or who knows, even more. And that's something that I really thought about a lot when I was, starting to trade options, and I continued to trade options, and I started making money, and I started thinking about all of the risk. There's something that really personally helped me that I want to share with you. Always think about the worst case scenario. And what would you do if that scenario was actually happening? What would you do if that worst case scenario, the worst ever, was actually happening? When you start asking yourself this type of question for each and every single trade that you take, I can assure you that you're going to start thinking about all of the risks that you're actually taking. And if you're fine with the risk that you're taking, it's absolutely fair enough. Like, who am I to judge? However, if you're not fine with the max loss that you could potentially have, or if you're not fine with the worst case scenario, and you don't ask yourself this type of question, it's almost sure that one day you're going to find yourself in this type of very bad situation when you'll be in a big loss that will probably wipe out all of your gains that you previously gained. That's why it's so important to, and personally that's really helped me to just ask myself every time I'm going to take a trade, what is the worst case scenario on this type of trade, and what would I do if it happens? If you have a plan and if you're fine with the potential max loss, fair enough. If you're not, don't take the trade. So we saw if I was, for example, bullish on the SPY, how I would personally sell the put credit spread. But what if I'm bearish on the SPY? How I would build my call credit spreads? Because when you sell a call credit spread, you have a bearish assumption. You think that the stock is going to go down. So how would that work? Well, as I said, I would still go into the same expiration, for example, the June 18, 2021 expiration that is expiring in 48 days. As I said, that's the type of expiration that I like to use. And I would go in there, and as I said, I would need to sell a call credit spread, because when you sell a call, then you're going to be bearish on the stock. And remember what I said before about the put credit spread? Usually for my short option, I'm going to go for the 30 delta strike. So in our case, for example, I would go into, for example, at the 428 strike. You see that it's at the 31 delta. As you can see, the delta column is over there, and the 31 delta refers to the 428 strike. So I would sell the 428 strike, and I would collect a credit of $4.02, making a max profit of $402. And as I said, for my long option, I like to go further out the money, like way further, for example, around the 5 delta, for all of the reasons that I just mentioned before. I'm not going to repeat them because now I think you start getting the concept and of why I'm doing things, but this is really important what I said, and I hope it's really useful for you. So as I said, I would go, for example, around the 5 delta, so I would go down. Now you can see, for example, I would go for the 450 strike, and I would pay 38 cents for my long option, making a net credit in total of 366, and so making a max profit potential on that trade of $366. If we go into the P&L graph, for example, if we look at how it would be at expiration, you see that if the stock stays below the 428 strike, then I'm going to make my max profit at expiration. If it goes above that strike, then I'm going to start being in a loss at expiration, with a max loss of around $1,800 maximum. And even more on the call side, I think it's so important to really understand the potential risk that you would have if you were selling a naked call, because it's quite different compared to selling a naked put. And here's the big difference. We tend to say that when you sell naked options, you have an undefined risk, meaning that theoretically your loss could be unlimited. Well, when you're selling a naked put, the lowest that the stock could go, and of course there are some exceptions, for example the oil, but usually when you sell a naked put on a random stock, usually the max loss that you could have is if the stock falls to zero, because the stock could not fall lower than zero. However, when you sell a call option or you just short a stock, for example, if you short a stock that is at $20, if it could go to $40 per share, in that case, you would make a loss of 100%. However, there is not necessarily a limit to how high the stock could go, meaning it went to $40, but what prevents it from actually going, let's say, to $80, to $100, to $120? And in that case, if the stock continues rising, you are going to lose more and more money, and you have the potential of losing way more than what you actually put and owe money to the broker. That's why it's so important to understand the risk that you're taking, especially when you're selling naked calls, because you could lose more than what you actually have in your account and actually be in debt toward your broker. Hence why credit spreads are nice. Call credit spreads are really nice, and personally, especially on the call side, I like to use call credit spreads because you just don't know. And of course, even on the put side, it could be risky, but I think that when you're trading on a more portfolio basis and you like to have those trades that are going to last several weeks, it's important to be protected, and you're just not going to end up in a very bad situation where you just owe money to, let's say, a broker. I mean, that's a terrible situation to be in. And of course, know that, for example, if the trade was going into a loss and I would, for example, be at a running loss of, let's say, $900, I would not just wait for my loss to actually, happen. I would obviously roll my trade, as I said for the put credit spread example. I would roll my trade to a later expiration so as to resell my trade into a later expiration and have the potential of recouping all of that previous loss and making a profit on top of that. That's why you roll trades. That's why even though you see that the max loss is, for example, $1,800, or like before it was $5,000, know that you just don't have to consider that max loss as something that is going to happen for sure. You can obviously defend your trades, you can try to turn losers into winners, and there's a lot of things that you could do so as to try to turn those losers into winners. So when you see that max loss is at $1,800, for example, don't consider that as it's either going to be like a winner or a loser, and if it's a loser, you're going to lose $1,800. First, know that that max loss would be at expiration. Second, you wouldn't just wait for your trade to go into a max loss of $1,800. I mean, you could defend your trade before that and roll out, for example, your trade to a later expiration. So now that we saw the two different examples with a put credit spread if you're bullish and a call credit spread if you're bearish, what is my real opinion on the SPY? Well, if I had to choose a camp between, let's say, the bullish side and the bearish side, I would probably go right now for the bearish side, meaning that I would sell probably a call credit spread right now. And if we look at the chart, that wouldn't really surprise me if we were seeing a pullback, let's say, and the SPY was going to, for example, the 405 level. That's something that I think would be quite doable in a way that the SPY has just been rising since the last year like crazy, and rare are the times where we had some pullbacks. We had some, for example, in September, August, and then we had another one in October, and then just from there it was just a constant bull market. So I think it's going to be healthy if we have some kind of pullback just to let the market breathe, because this is really a strong uptrend right now that we have. Usually on a yearly basis we don't see that type of uptrend. That's why I don't think that a pullback would be necessarily bad, and I think that it could be expected that we're going to see a small pullback going, for example, to the 405 level. So in our case of, for example, the call and credit spreads, that's personally what I would exactly do, because I think that we're going to face a small pullback. And that's funny now, if you're going to watch that video, let's say in like 3 months, and you see that the SPY just went straight up, that was completely wrong. But that's the good thing about also selling a call and credit spread, meaning that even if I'm wrong, let's say on the next 6 months, and you know, the SPY just went up, like you don't necessarily need a huge pullback so as to be in profit on your call credit spreads or on your put credit spreads, for example. You can just see some small pullbacks and, for example, a decrease in the implied volatility, and you will be in a profit, and you can just take your profits there. You know, you don't need to have a crash just to be profitable on that call credit spread, for example. Even if the SPY was just falling, for example, to 400 and let's say 5, I would already be in a profit of $50 minimum. So you see that you don't need to have huge movements just to be in profit. You could just be in a profit just because of the decrease of the implied volatility, and also know that when you're selling options, when you're selling credit spreads, you also have the time decay working in your favor. And for those who don't know what is the time decay, every day that passes, options tend to lose a tiny bit of value, and the closer you are to expiration, the bigger that value that they are losing on a daily basis. And as you sell options, you want the price of those options to decrease. That's how you're going to make a profit. So if you have that time decay that is taking value out of options, then it's helping you, because you want the option price to decrease. So the time decay is exactly doing this. That's why even if the SPY doesn't necessarily go down right now, or let's say it doesn't go down, for example, to the 405 level, it just goes down, let's say, for example, to the 410 level. Well, this plus maybe a decrease in the implied volatility plus the time decay working in your favor, there are pretty good chances that you're going to end up in a profit, even though you were not necessarily right in the direction. And that's why I like selling credit spreads, and especially wide credit spreads. I hope you find this video useful, where I just share my thoughts on the SPY and how I would personally sell put credit spread or sell call credit spreads. If you have any question, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. And the purpose of these videos is really to help you understand how I would personally approach some trades, so as to really give you the methodology that I'm following, so you can really make decisions based on your own thinking, and you can really do it by yourself. That's really the purpose of these videos. So if you end up appreciating this video and it actually brings you value, then don't hesitate to subscribe to my channel and liking this video. As I said, it's the best support you can give me, first, and second, it helps me know in my analytics which type of videos you like to see. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.